Welcome to Minted for your update on the past week's financial and economic recap. Major economic events happened this week that could fundamentally change how you think about your money, your investments, and your financial future. While most people were going about their daily lives, central banks made decisions that will ripple through markets for months to come. An unexpected merger sent shockwaves through an entire industry, and inflation data revealed something economists didn't see coming. You're in exactly the right place to get the complete breakdown of what happened, why it matters, and most importantly, what you need to do about it. Stephen Miron, a Federal Reserve governor whose term ends at the end of January, said on Thursday the 8th that he is looking for 150 basis points of interest rate cuts this year to boost the US labor market. Miron told Bloomberg Television's surveillance program that Fed officials had room to further reduce rates, given his view that underlying inflation was likely running at 2.3%. He stated, "I'm looking for about 1.5 points of cuts. A lot of that is driven by my view of inflation. Underlying inflation is running within noise of our target, and that's a good indication of where overall inflation is going to be going in the medium term." Miron's comments offered a more precise view of his target for rate cuts this year, after he told Fox Business Network's Mornings with Maria program on Tuesday that well over 100 basis points of cuts are going to be justified this year. U.S. Treasury Secretary Scott Bessent will press the administration's desire for lower interest rates in a speech to the Economic Club of Minnesota, CNBC reported, citing excerpts of his prepared remarks. "Cutting interest rates will have a tangible impact on the lives of every Minnesotan," he said, according to CNBC. "It is the only ingredient missing for even stronger economic growth, which is why the Fed should not delay." Fitch Ratings on Thursday raised its estimate of U.S. GDP growth in 2025 to 2.1% from its earlier forecast of 1.8% and lifted its forecast for U.S. GDP to 2% for 2026 from 1.9%. It estimates that inflation rose to 3% in December and will end 2026 at 3.2%, reflecting delayed tariff pass-through. Miron's call for 150 basis points of cuts is in line with the lowest projection for the appropriate funds rate by the end of 2026 among the Fed's 19 policymakers, released at the end of December's rate-setting meeting. That anonymized estimate saw the Fed funds rate at 2.00% to 2.25% versus the current level of 3.50% to 3.75%, and is also 50 basis points below the next lowest estimate. Miron's term as a Fed governor ends on January 31st. He is controversially serving at the Fed while on leave from his role as a top economic advisor to President Donald Trump, who has repeatedly pressed the central bank to deliver big rate cuts. Major shifts and volatility within commodity markets. Oil prices settled lower for a second straight session on Wednesday as investors digested U.S. President Donald Trump's deal to import up to $2 billion worth of Venezuelan crude, a move that would lift supplies to the world's largest oil consumer. Brent crude futures closed down 74 cents or 1.2% at $59.96 a barrel, while U.S. West Texas Intermediate crude fell $1.14 or 2% to $55.99 a barrel. Both benchmarks slid more than $1 a barrel during the previous trading session, with market participants expecting ample global supply this year. Venezuela will be turning over between 30 million and 50 million barrels of sanctioned oil to the US, Trump wrote in a social media post on Tuesday. The deal between Washington and Caracas initially could require the rerouting of cargoes that were bound for China. The US also seized an empty Russian-flagged Venezuela-linked oil tanker in the Atlantic Ocean on Wednesday. Providing some support to prices, U.S. crude stocks dropped by 3.8 million barrels to 419.1 million barrels in the week ended January 2nd, the Energy Information Administration said. Analysts had estimated a rise of 447,000 barrels. U.S. gasoline stocks increased by 7.7 million barrels in the week, the EIA said, compared with analysts' expectations in a Reuters poll for a build of 3.2 million barrels. Distillate stockpiles, which include diesel and heating oil, climbed by 5.6 million barrels in the week versus expectations for a rise of 2.1 million barrels. The S&P 500 and Dow Jones Industrial Average have traded near or at record levels early in 2026, reflecting continued investor optimism heading into the new year as markets await key economic data. Britain's FTSE 100 gained 0.4% to 10,085.47 in early trading, while the CAC 40 in Paris rose 0.5% to 8,287.19. Germany's DAX edged less than 0.1% higher to 25,132.43. The Chinese artificial intelligence startup Minimax, whose shares debuted on the Hong Kong Stock Exchange on Friday, surged 109%. A wave of bullion selling worth more than $10 billion is providing the first big test of the market in 2026, as last year's stratospheric run-up in gold and silver prices comes under pressure. Funds that track commodity indices are rebalancing their holdings and are expected to sell about $6.1 billion of silver and $5.6 billion of gold during the annual rebalancing window running this year from January 8th to 15th, according to calculations from JP Morgan. Nikki Shields, analyst at MKS PAMP, says, "It is the industry's first big test of how sustainable the December moves are, given we are starting 2026 at such a high base." Gold prices have fallen 0.6% since Tuesday's close, while silver prices are down more than 4% in the same period. The yellow metal soared more than 60% in 2025, with silver rising more than 160%. Gregory Shearer, an analyst at JP Morgan, said silver would see the biggest sales of any commodity during the rebalancing. He estimates net selling of silver equivalent to about 10% of the value of all the open derivatives contracts on trading venue COMEX. Bitcoin remained somewhat stable over the past 24 hours, trading within a narrow price range and returning back toward Thursday's lows. The OG of crypto is currently a tick above $90,000, firmly in the range it has been stuck in since late November as trading volume dries up. Daily volume fell 9% in the past 24 hours to $38 billion, a long way from a few months ago, when it regularly ranged between $80 billion and $130 billion. The lack of trading activity coupled with low liquidity has led to choppy price action across Bitcoin and altcoins, with several spikes over the past few months that rapidly get reversed, punishing traders that trade with leverage. That's it for this week's recap. I hope you enjoyed the video and got what you needed. Leave a comment below of what you'd like to see included in the videos. Weekly recaps are posted every Saturday, 5 p.m. GMT. Thank you for watching and goodbye.